Here with George from National Bank of Arizona. George, thanks for being here today at my listing. We're here in Goodyear. This beautiful home, 4 bedrooms, 3 bath with a loft, 3 full baths, a loft and 3-car garage. It's listed at 305. So if you want to come check it out, give me a call, the number below. Have George here, and we're going to talk a little bit about credit rating. I often talk to folks who either they don't know what their credit is, they haven't checked their credit, they think they have bad credit. So, quick question, George. Explain to us what makes credit bad, good, and excellent.
Definitely, yeah. Well, thank you for having me.
Yeah.
Great open house, phenomenal home. I walked through, very spacious, gorgeous. So come check it out if you have some downtime this weekend. But good credit, usually, I mean, there's very low usage of credit cards, revolving accounts. Typically that drives that score, installment loans, just an overall exposure of credit, credit experience.
Okay.
Installment loans, auto loans,
Okay.
maybe previous mortgage loans that they've paid very well on. Those are the kinds of things that potentially make a good foundation for a good credit score and great credit history.
Okay.
Mediocre credit, maybe you use a little bit more credit cards, more revolving, you're past a certain threshold where it starts affecting your score, but you can come back and get it back into the good score, by paying it down.
Okay.
Yeah, a lot of the revolving accounts, and revolvings are, again, those are credit cards that allow your credit to fluctuate quite drastically. I mean, I've seen in my experience, I've seen low 600s, and as soon as they pay credit cards off, they're in the 700s.
Okay.
So sometimes that availability that helps of those credit cards being paid or paid down.
Okay.
And then bad credit usually consists of charge-offs or collections. Medical judgments, tax liens, bankruptcies,
okay.
Those kinds of things, and those certainly have a waiting period.
Mm-hmm.
Judgments usually need to be cleared up,
okay.
for the most part. Bankruptcies have a waiting period depending on the loan program that you end up going with. So that's like a Chapter 7 typically. You're either at a 2-year or a 4-year waiting period with those, and then collections like medical stuff. And a lot of the time, the best spot to really start is check with the local lender. Like,
okay.
Like myself, I'm local here in the Goodyear area. And we can go through a pre-qualification process and really identify a lot of those the credit challenges that you may or think have, and they may not be there.
Mm-hmm.
And you're perfectly a good candidate to potentially purchase a home. And if there are some challenges, we can give advice on how to correct those properly or get them removed. Or if they're old, there may be a point where you can dispute with credit bureaus to take them off.
Okay.
And that could be the changing factor in all of this and help you qualify. So there are many little different tweaks here and there that we can look at as as professionals and advice to be able to get you into a home, and maybe maybe not now, but maybe in 6 months.
Okay.
It could be an opportunity to definitely do that.
Just definitely take a look at your credit, even if you're not ready to buy a home today. It's a good to always take a look at it. A lot of folks use Credit Karma. The thing with those, what I've heard, and maybe you can speak on this, is those don't necessarily report the same way a mortgage lender's credit report does. So you may have an idea, but it's always good to check with the lender to see where your score is at. Right.
So Credit Karma, it's a great tool just to have. Monitor your credit, your credit trade lines. Make sure there's no fraud or anything fishy that might come up, especially with all these breaches.
Mm-hmm.
It's a great tool to have.
I wanted to ask you and see if you could explain what debt-to-income ratio is.
Yeah, so
in a nutshell.
Definitely, yeah. Debt-to-income ratio is another very important piece to the process of getting pre-qualified, because that determines how much you can afford as a home. So that's really going to determine a lot your income to basically be able to afford ratio. But the debt to income basically is your whole income versus what that income services for these debts that you have.
Okay.